Hello, and welcome to Trim and Brown's presentation concerning the introduction of the Dividend Allowance. 2015 was a year of surprises in the political world. The Tories winning the 2015 general election in itself was a major shock, but even bigger was the new tax legislation that the then Chancellor, George Osborne, brought forward in his July 2015 budget. Commentators were struck by how Mr Osborne was stealing Labour's clothes with his policies. One major policy announcement was the new living wage legislation. Another new policy which struck a chord were the changes to the tax regime for private landlords. However, one policy announcement which did not get the same publicity was the introduction of the dividend allowance. For years, HMRC has wanted to act against one-man band limited companies which have used the limited company status to reduce their tax liabilities. In this three-part blog, we will look at why HMRC finally acted against SMEs, the new tax legislation HMRC brought into force from the 6th of April 2016, and how SMEs may still arrange their tax affairs using limited companies to save tax. So why has HMRC brought forward the dividend allowance legislation? To understand HMRC's reasons, we will start by looking at limited companies. What we know as a limited company came into being in 1856, although the legal requirements surrounding limited companies have been constantly amended, with recent changes making them a far more attractive tax vehicle. In the mid-1990s, audit exemption was phased in. This means that companies with a turnover less than £10.2 million are exempt from audit. Therefore, accountancy fees for companies claiming this exemption have been greatly reduced. The 2006 Companies Act made it easier to form a one-man band company. There was no longer any need to have a company secretary, and only one subscriber or shareholder is required. Recent history has shown an explosion in the number of companies formed. Around 4 million companies were formed from 1856 up to the start of this century. This year, 2016, saw the incorporation of the 10 millionth company. There are a large number of reasons why companies incorporate, but the three most important ones are: first, limited company status provided prestige and credibility to any business through the audit. However, the continuing amendments to the Companies Act has removed a lot of the prestige of using a limited company, and the audit exemption legislation has certainly diluted the credibility of published accounts. Secondly, an important consideration to any business incorporating was the concept of limited liability. That is, the shareholders' liability is limited to the amount that they have put into the company. The concept of limited liability has been diluted over time. An example of this would be banks' insistence on directors giving a personal guarantee when loaning money to a company. The third and most important consideration for incorporating a business is, of course, tax. So how does running the business through a limited company reduce the tax that the business pays on its profits? To see how a limited company can reduce the tax on profits, let's first have a look at the tax code governing other business models. Apart from limited companies, a business can be run as a sole trader, as a partnership, or as a limited liability partnership. The tax code on business profits governing these three models is essentially the same. They are currently subject to three types of tax on their business. First, the owner or owners will pay income tax on profits at their marginal rate of tax. Secondly, the owner or owners will pay a flat rate tax called Class 2 National Insurance. For the tax year 2015-16, the weekly rate was £2.80. Finally, the owner or owners will pay Class 4 National Insurance on profits. For 2015-16, the business would have paid 9% on profits between £8,060 and £42,385, and then 2% thereafter. Keep in mind those two figures of £8,060 and £42,385. The tax plan involving the use of limited companies is based on those two figures. From the 1st of April 2015, all companies pay corporation tax on allowable profits at 20%. The important point to note is that directors can draw monies from the company in three ways: reclaiming business expenses, salary, and dividends. It is the rules surrounding the drawing of salaries and dividends which make limited companies such an attractive tax-saving vehicle. The important point to note about salaries paid to directors is that the national minimum wage and national living wage legislation does not apply to them, unless they also have contracts in place that make them workers. Directors of SMEs have used this rule to pay themselves a lower wage and then draw more money from the limited company as dividends. The most tax efficient annual salary for 2015-16 was £8,060. That is the lower earning level for Class 1 national insurance. At this level, no income tax or national insurance is normally payable. The salary is a relievable expense for corporation tax, and the director still gets credit towards state benefits, even though no payment of national insurance is actually made. Dividends are a very popular way for directors of SMEs to draw profits from their companies. This stems from the fact that as long as the director's personal total income, including gross dividend income, was below the high rate tax threshold, which for 2015-16 is £42,385, then there was no personal tax to pay on the receipt of the dividends. Up to the 5th of April 2016, all dividends included a deemed dividend tax credit of 10%, which grossed up the actual payment for personal tax purposes and meant no basic rate tax was personally payable. If you went into the high rate tax band, then the element of the dividend in the higher tax band was taxed at 22.5% of the gross dividend, which was effectively 25% of the cash dividend received. It is vital to note that dividends can only be taken from post-tax profits. The best way to illustrate how businesses can use a limited company to save tax on profits is to give you an example. Here, two friends, Ben and Tim, have both made a profit of £40,000 for 2015-16 from their respective businesses. Neither received taxable income from any other source. The difference between them is that Ben trades as a sole trader, whereas Tim trades for a limited company and pays himself the tax-efficient salary of £8,060, and in addition draws the maximum possible dividend. So who pays less tax on their business profits overall? Let's look at the figures. For 2015-16, Ben can reduce the amount of profits taxable for income tax purposes by applying his annual personal allowance, reducing the amount chargeable to £29,400. Ben is a basic rate taxpayer, so the income tax payable at 20% on the amount chargeable is £5,880. Ben would also have to pay Class 4 national insurance on profits between £8,060 and £40,000, which comes to £2,874 and 60p. Finally, Ben would pay Class 2 national insurance totaling £145 and 60p. Therefore, for 2015-16, Ben would have had to pay total tax of £8,900 and 20p for his business. For 2015-16, Tim's limited company can reduce its taxable profit from £40,000 to £31,940 by granting him a salary of £8,060. The company would pay corporation tax on net company profits of £6,388. Tim could then draw a maximum dividend of £25,552 from the company, which for personal tax reasons would be grossed up to £28,391. Combined with the salary drawn from the company, Tim's personal taxable income is £36,451. This figure means that Tim is a basic rate taxpayer, meaning in turn that there is no income tax liability on either the dividend or indeed the salary, which is covered by Tim's personal allowance. Tim will therefore pay no tax on his drawings from the company. So, comparing Ben and Tim's overall tax position, it is obvious that at a profit level of £40,000, the most tax efficient vehicle for the business is to incorporate as a limited company. But would limited company status remain more effective at other profit levels? As you can see in the table, at virtually all profit levels, it is more tax efficient for the business to incorporate as a limited company. In practice, most accountants would advise SMEs to incorporate when profit levels were around the £25,000 mark. That's because any tax benefits prior to this figure would have been swallowed up by increased accountancy fees. In part 2 of this series of blogs, we will look at how SMEs use the flexibility of limited companies to reduce their tax liabilities even further, and how HMRC finally took action in July 2015. If you have any questions surrounding the information covered in this video, or indeed any queries regards to tax or business planning, do contact us on the details given on the screen. We look forward to hearing from you.